Recently, I had wild experience with another agent and client who brought me some illustration, which was pretty troubling to find out how they view IUL and what's being sold and told to them. So diving deep into this, it might upset some people, but this is the reality of things. So
I mean, at the end of the day, and I used to worry about that too in regards to the content. It's not really about, especially the people in the industry, because I could care less because they should be reprimanded, lose their license, E&O insurance should be utilized, and they should be fined for the things that they're doing, to be honest. And I even, as recent as this week, struggled with the amount of effort and energy I spend talking about the IUL and whether or not I should. But if I don't, then nobody will. And the conversation will just run together and they'll think that infinite banking is the IUL or that permanent policies are the same as whole life and that cash value is cash value. And it's just not.
correct. It's not. And it's sad because another agent mentioned to me that their IMO was explaining to them that becoming your own bank using an IUL was just like besides myself. How can you run an agency that has hundreds of agents running around with advertisements on social media, pulling in leads, and then telling a client that what you're looking at of a hypothetical illustration is going to become reality, and the agents believe this stuff when they're looking at it because it starts with the top down, so whoever you're getting your training from, the education from, and you never question it. And that was the sad part to me is, when as soon as I asked the agent, well, what was the product, and when they said the name of the carrier, like F&G or NLG or North American or something, I already knew off the bat it was an IUL.
Yeah.
And it's just sad because there's so many people out there, hardworking people that are getting hurt in the long run, not the short term, because it looks good on paper, right? But it's the long term effect that they're going to see and feel in the upcoming year to another decade. Am I correct on that way?
Yeah, I would argue the short term too, because if it really was infinite banking, then you're not necessarily parting with your client. So it affects their ability to sustain their life now. So it's both short term and long term impact because obviously we know what happens over time. But in the immediate, now you're setting aside money that you could be putting and stewarding in the proper place and not give up access. And I used to say the blind leading the blind, but like you just said, this is their leadership team. And I find it hard to believe that their leadership doesn't understand the difference and know what they're doing and isn't doing it for the sake of profit. And I know we live in a capitalistic society, but at some point, like you got to draw the line somewhere. And you're
Yeah.
putting people in harm's way just for the sake of profit. And the people, like you said, are none the wiser because they're being recruited for this six-figure income, selling trucker IULs, selling
Mhm.
pet IULs, when it really is, regardless of what category you put them in and how you market to them, it really is the last thing that they should be doing with their money to prepare for what you're quote unquote preparing them for.
Correct. I mean, to say things like become your own bank or do what the Rockefellers do or Walt Disney, Ray Kroc. And it's funny because, the IU and the agent they don't take the time to learn it themselves. But the establishment of IUL was like 1999 or something, like almost 2000, where I think it was Transamerica that was the first carrier to come up with this ideation. And they're like, oh, this is a good idea. Universal Life didn't work because the guarantees on they fell short when the guarantees were over exceeding the cost of insurance. And
Right.
yeah, right. And the VUL, the variable universal life, those were hot topic, hot tickets when, Black Monday, Black Friday, all these market crashes. Because the only way to go up in those variable situations was astronomical. You can make 20, 30% returns, but the
Yeah.
variable universal there was no guarantee. So when those two have been falling off of the cliff, then they came out with IUL, which has only been established really, in my opinion, even though it might have been the first in 1999 with trans, it wasn't until I really truly believe in 9/11, '01, where we had that 9/11 crash, or '08 even, where companies like three-letter words like, well, whether they're WFG or PHP, that took the rise of IUL to say, it's a long-term investment in their brain, in their mind. That's what they're saying, investment, when it's not, but that's what they're selling it on. A long-term investment alternative to your 401k. Let's look at these illustrations. But when companies like AIG or PAC are illustrating at 11 or 12% to compete like a beauty pageant, of course they're looking great and fantastic later on down the road. So they found a way to come up with a product, right? An IUL product where it hurts long term, not short. right? And then everyone has to understand that it wasn't around in Walt Disney era, Ray Kroc, McDonald's era, the Rockefeller. It was, you know what I mean?
Yeah, I don't think that they realize that. They're just going along with it and it sounds good and they're not connecting the front end to the back end or A to B. They're going straight from A to Z. And like you said, it didn't even exist. So, I mean, to market it as if, and it's crazy that you mentioned those companies. I actually joined somebody's community because I was curious and I do this often, join their communities or consume their content just to see what's going on. And they have this quick start program where it says you need to do this over the next 7 days. And listen to this. It says lead with 3 moves, not the death benefit. Move one is buy, borrow, repeat, which is great, but you can't do that in the beginning with an IUF because you run the risk of it imploding. And this is where I'm just gonna say it, this is where I kind of got pissed. Because move two is setting it up right so you can get to the money. And move three is instant legacy, stack proof behind it. Disney, Ray Kroc, McDonald's, and the money banks hold in life insurance when they believe it builds wealth to dispel their objections. And I learned from you, and I knew that they didn't buy that when banks had life insurance. I know they have billions in life insurance, but I knew that it wasn't an IUL just because I knew that the IUL was structured the way it was and the gaps that it had. But then you educated me on what it was and why. So I think that's a great place to start
Yeah.
is helping them understand like what banks are actually buying and why.
Yeah. Yeah. So back then, I mean, and this has gone around 200, almost 200 years. This is how long, like whole life. So for the basic, understanding of life insurance without complicating it for anyone who's listening or watching is there's only two types of life insurance. There's term, right? Like you've seen those guys at Primerica, you've gotten calls from them already, right? Buy term, invest the rest, right? And then you have just permanent, which means for the rest of your life. But in that permanent drawer, if you open it, there's different types of product lines within that chassis, like final expense burial plans, universal life, variable universal life, IUL. There's whole life, like Dave Ramsey, Susie Orman talk about, or your State Farm Allstate whole life, all based, just death benefit. And then what I like to call what we do for infinite banking is more like a modern whole life, or I call it hybrid whole life. It's like a blend. So it's because like I like the word hybrid because it's something new. It's a blend between all of those within the permanent chassis. And then maybe you'll understand more about the product. Because saying IBC, you don't know what it is. I just
Yeah.
like it's just like saying TFRA, tax free retirement, whatever.
Well, I wouldn't even put in, I mean, I'm okay for the sake of the conversation, but I wouldn't even put ULs in that permanent because that's what they do
Oh, yeah, they are. Yeah,
eventually and
UL,
very
VUL,
intentionally.
IUL, all permanent policies. So people always associate, and I love it when I say, and I ask the question to a lot of the clients or prospects, you have life insurance to protect your family. That's amazing. What kind do you have? Oh, I have a whole life. Okay, great. Let me ask you something. Is it connected to like an S&P index or something? Well, yeah, okay. Well, it's an IUL because the agent sells it as a whole life, not understanding that whole life is its separate product line. It's a permanent policy, right? So there's term, like a 5, 10, 15, 20, 30-year term where you can get like $50 a month for $300,000 of a death benefit, but then you're renting a policy and then it terminates at the end.
Hmm.
The whole life structure is very different within the permanent, drawer, let's just say. So people have to understand first and foremost, those are only two different types of life insurance that you're going to choose from. Right now, everything related in the permanent drawer, permanent chassis, underlining the universal life product, whether it's UL, VUL, or IUL, they're all built on the term chassis also inside of it. So it's an annual renewable term product inside of a permanent drawer. So yes, it's for the whole life of your the permanent life of your till 121. But when you're 40 years old or 30 years old, it's very different when you're 70 or 80, like my dad. And I only know this stuff because I have proof to validate it. I'm not sitting here saying, IULs are terrible. And then someone says, well, how do you know? Well, I have them. So I know. And I've been doing this 25 years. So I know exactly what they look like and how they run and the integral parts because I know what's under the hood. So yeah, that's the best thing I always tell people is they're not as flexible as you think. The illustrations are fake. It's fantasy, not reality, because I can prove it. And anytime there's someone that battles against the conversation about IUL, whole life, mine's better. I just tell every agent and any prospect, let's just start here. Show me your permit, your IUL, and I need to see your original illustration that you have with your policy from 4 or 5 years ago or 10 years ago, and compare it with your current annual statement. If I can see both of those, well, then we actually know reality versus fantasy. And I'm telling you, 99.9% of every single one that shows me it, if they can, right, it doesn't look the same, and they can't look the same. Right. I will dive deeper into it to explain to everyone why it won't ever work when they see it. But what experiences have you been seeing now that you've been in the industry for a long time and knowing everything that we've been through since we met years ago, the IULs that you're seeing today, like how is that affecting people when you're looking at the old policies that they have?
Well, I think for starters, I want to go back to the fact that you said it looks different at 40 and 70 in the annual renewable term, and explain that the reason it does is because of the fact that it's an annual renewable term. So typically when you buy a term policy, you're buying it for a defined period of time, a specific term, and then it terminates. Unlike what they say at Primerica, where they say you have term insurance up to age 9, it's still a 20-year term. And then from 20 on, either you renew it or it turns into an annual renewable term up to 95 until it's not affordable anymore, until it's
Mhm.
cost prohibitive. And what that means is that every year with an annual renewable term, the cost of that insurance, the cost of that $300,000 worth of insurance goes up by age. So at 40, it's one price. At 41, it's another price. At 42, it's another price. And it really is the equivalent of running on a treadmill at 7 for your entire life. At some point, you're gonna get tired, and when you slow down, you'll fall on your face, and that's what happens in IUL. But
Yep.
to answer your question in regards to what I've been seeing, and what I've seen is just a gross misrepresentation of what's going to happen, and only speaking to the current assumptions column, and not the guaranteed or midpoint, and almost and all but minimizing it. Well, actually minimizing it and saying the only way that this is going to happen is if we go into the next Great Depression and the world falls apart.
Hmm.
That's the only way that this will happen. So this current assumptions is actually, it's illustrated at 6.75, 7.5, or whatever the maximum amount that carrier will allow to illustrate. And if you know the S&P 500, what it's been doing 14, 20, 25%. So this is actually modest compared to how your IUL will actually perform. And that's just a gross misrepresentation, because even those numbers are convoluted, because that's January 1st to December 31st. And the way that your IUL credits is not January 1st to December 31st.
Hmm.
So that's a gross misrepresentation of the product itself, how it performs, and the capacity of what you're getting. So that you walk into something and you don't know what questions to ask. And a lot of times the agents are just regurgitating information. They're
Correct.
just learning word tracks to overcome objections or to eliminate or alleviate objections so that it never comes up to begin with. But in
Hmm.
all actuality, again, it goes back to what we said before. Leadership is just padding the bottom line, because they know if you look at maybe somebody that you followed a year ago, 2 years ago, that was talking about IULs, because they're marketing, they're learning how to market. They're not learning how the product, the vehicle works, how to sell the vehicle. They're learning how to market the vehicle to get you into this funnel to ask you some silly question, which is another telltale. After they explain how great this is, like, how much can you afford to set aside? It's like going to the mechanic and them saying, "What do you want me to work on today?" That's not like, you don't do that in any other aspect of life. So why are you comfortable doing that here?
Yeah.
None of it makes sense. And then people are getting into it, I don't know, a year, 2 years, 3 years, 5 years. I've had people as of late, even after the surrender period has started to kind of diminish, and still move it over, because even then you're light years ahead because of the consistency
Oh,
that
yeah.
you get by transitioning. So even if you're out of the surrender period and you have access to all of your money, and if you're not, I would still recommend getting out now and just taking the lumps and moving on, and just cutting your losses. But even then, like, going forward, if you have access to all of your money, the fact that you have guaranteed consistent growth for truly for the rest of your life, and have unbridled access, and not have to look over your shoulder when you borrow from it because of the rising cost of insurance. And what happens when the cost of insurance is going up and you're still paying the same amount, and now you have an outstanding loan that's pulling down on the policy.
Yep.
And if it doesn't credit, then now your policy is just chipping away at the money. It's just it's a shit show.
It's going to be in my opinion, it's going to be the next recession crisis in insurance, which is it's going to hurt a lot of people. It's going to bring a big wake up call to these carriers. But to touch on a couple key points so everyone understands, within the indexing mechanism or credits, when you're looking at an illustration, and like Wayne's mentioning, and they're illustrating it at 6.9 something percent, they can only illustrate at a certain maximum in that policy or illustration because there have been guidelines called AG 49 and AG 49A and AG 49B because the regulators had to come out and stop these carriers from putting in bonuses and multipliers and trying to get it above and beyond the expectations so these illustrations look pretty and beautiful. And that's the problem, is the minutia that goes on with these IULs, illustrations, or salespeople is they're selling you on the average rate of return of the S&P or the 25-year look back of the Hang Seng, the Euro, whatever it is that they've made up on these arbitrary indexes. And now when you're looking at an illustration, it's going to tell you that 6.94% is what you're getting in the non-guaranteed column. But the agents are telling you that it's an average return. And the problem is it's not. And that's where the agent, and like you said, it comes from the top down. They don't want to know how this works because if they did, they wouldn't sell it. Or they would, but they're just greedy, right? Yeah,
Yeah.
you could have conversations about that anyway. But just so everyone understands, when you're looking at an IUL illustration, understand those are not average returns. Those are uninterrupted compounding effects of money, as if for 50 straight years, you're earning 6.94% every year with no zero, no interruption. And in reality, that's not going to happen. And also, in order to get an index credit on these types of policies or products, it has to be 1 year or something point to point. Like you've heard that before. So how can you show me an illustration when if I have the S&P index and I sign Wayne up in August and his wife up in September, that any ticker number that shows 1 year point to point, Wayne can get an increase and his wife can get zero? You see what I mean? So you can't show me something because everyone's policy at different anniversary dates are going to be completely different. And that's what agents have no clue, right? And to put a little cherry on top, I showed the agent that one of the brand new indices that just came out with a carrier, I won't mention, because they don't know what a prospectus is. They never looked at it before. They don't even know what a prospectus means. So what I said is, let's just go to Google and I'll show you the inception of this index that was created. This thing was created in 2019. How can you give me a 25-year look back of something that's been inception for less than 7 years? Are you kidding me? And tell me that this is legal? Because the agent was, how is this legal? How is it? How? Because it says in the fine print that no one reads, right? They just show that 1 or 2 pages. It says you as the agent who is liable with E&O insurance, right? Errors and omissions. You're signing acknowledge that you are explaining to the client, and the client is signing stating that they fully understand what you're saying. So now you're liable, client's liable, and the carrier is not. That's why it's legal. And no one reads the fine print. So I'm very, I'm sad for the industry. I'm sad for the clients. But at the same time, it's it's ridiculous how much money they're making doing these and selling these and not caring who they're hurting. You know what I mean? It's just sad.
I
And
think the most unnerving part for me is, and I've talked to a lot of agents over the past, I would say, 3 years since the IUO has really caught fire, the last 3 to 5 years. And when we talk about it, and I go through infinite banking, the response almost every time is, "Wow, I can't believe this is it. Like this is what we should be selling. This is what the client is looking for." But the amount of information, I guess, the knowledge that is required to communicate it intelligently and simplify it for the client is, I guess, it's demoralizing for an agent, and they just don't care. They just don't want to work that hard. They don't want to put the time, effort, and energy in. And a lot of times they spend a week, 2 weeks, maybe a month going through an IUL boot camp where they learned all these word tracks and these things to point out and how to sell, because they are selling, how to sell an illustration. They're not providing a solution or helping anybody.
yeah,
And then when they realize that this is what it should be, and I don't think it's any more complicated. I think it's just the idea that you have to start over. And I don't even think it's starting over. I think that and the reason why it's so effective is because a lot of things that exist in the IUL exist in the whole life. There's just a learning curve in illustrating it, a learning curve in the way that the conversation sounds because it is a little different.
yeah,
And then as a result, you have to make yourself available for the client because there's more moving parts
Correct.
and there's more in and out, which is what they want anyway. They want to become their own bank. And there's a difference. Like we both say becoming your own bank, but when? Am I becoming my own bank when I get the policy, or I'm becoming my own bank in 10 years? Like when do you want to become your own bank? Because that in itself, if everybody asked that question, or even if the client said, "Hey, when will I become my own bank?" Because any agent worth their weight in salt, even the most unscrupulous agents, agencies, IMOs are still telling people that you can't borrow from it for the first 5, 7, 10 years. And that in itself should be a red flag, because how am I becoming my own bank and I can't touch my money for 5, 7, 10 years? That doesn't make any sense. So from there, it should be more of a commonsensical conversation and
Yeah.
should be an indication that there's something else that exists, because that's a gaping hole in the conversation from the beginning, including the market.
Yeah, to that point is when you're saying become your own bank, the number one reason why you can't become your own bank in the IUL is what Wayne's talking about, is because for the first 10 to 12 or even 14 years, these IUL carriers, they have surrender charges, surrender penalties in those timeframes. The reason why is because when you give the insurance company $6,000, $500 a month, the agent is taking all that for commission. So if you surrendered your policy in year one or even in year two, some of these, I mean, I've seen some where they have zero cash value until year four. That's when I know the agent just took so much advantage of that client. I hate saying the word, like they raped them, but they did. All
Yeah, I
right.
mean, that's not at that point, it's not even
So much.
structured properly by IUL standards.
Oh, like they totally like $6,000 on a premium. Their target premium was like 7,200.
Yeah.
Like more money like than that. Like that's just outrageous that it's even legal that they can do that. But that's the reason why there's surrender penalties and charges built in. And when these agents or even the carriers, regional sales managers come and they say, these are properly designed. Oh, he didn't design it properly. Like the software, just so everybody understands, the software that's built from the carrier is already properly designed to benefit the carrier, right? So the only thing the agent has to properly design is toggling the death benefit higher or lower. Do they want to have more commission on the high side, or they want to lower the death benefit and let the client have a little bit more access at a shorter duration? Right? That's a good agent if that's what they're going to do. Being naive to the fact of not understanding the full product. But the first thing is, look, if someone's approaching you with an IUL, number one, ask them to show you their personal policy, not an illustration, their physical personal policy with the original illustration they had of their policy. That's the first thing. If they don't even have one, then just run for the hills. Because how can you buy something from someone that doesn't even have one and believe it themselves? That to me is like shuts them down completely. But before you buy one, get the illustration they're trying to sell you and come along and share it with the Hidden Gems, Wayne Carr and I, and Scott Genad that do what banks do. And we'll be happy to review it for free and show you the differences between something that's going to be fantasy versus something like Infinite Banking that's been around for 200 years that Wayne and I both have, right? Because when we say become our own bank, we are using this stuff on a daily basis. And I have four of these things, even from my 6-year-old. And we used it within 30 days to pay off credit card. So sometimes when you're thinking about people on social media telling you about tax-free retirement, it's looking very good to become your own bank, and then you can't even use it for, till you're 60 something years old, understand this and ask yourself, do I want to be debt-free and stress-free today using the money? Or do I want to wait 20, 30 years down the road and then start using it for retirement? Like, you can die before you even use it, right? Also, questions: would you rather have a consistent, uninterrupted compounding of 4, 5, 6% of dividends every single year, putting your head on your pillow, knowing that you can go to sleep at night, knowing you're going to get it every year? Because for 120 plus years, carriers have always given it through any recession. Or do you want to roll the dice on something that is hypothetical and projected, and you don't even know if you're getting indexed? Why? Right?
I'll take it one step further, and in the fact of asking the question if you want to be debt free today or if you want to be debt free at 65. If you're debt free today, then it truly, and it was already an asset, but then it becomes an even more valuable asset, because now you can look at leveraging it different ways. Like when people say paying cash for things, or the different ways that you can truly use it to accelerate the growth of money or acquire appreciating assets and do the buy, borrow, die strategy, things
Mm-hmm.
like that. So that also is the other side of it. So we're not just looking at, and that goes into the next thing where you talk about consistency. So we're not just looking at the rate, which is lower admittedly lower on the whole life versus the potential of an IUO. It's lower, which I think is okay as a secondary product. I don't hate it as much, but as a primary product, I don't think anybody should have it. But when you start talking about the consistency of it, now you can execute that buy, borrow, die strategy because this is growing consistently. This is appreciating asset. And now you don't necessarily have to pay it back because as long as this is growing and generating cash flow, you can recycle the money, never pay it back, and just continue acquiring assets. And if you're structured properly, now you're really building and strengthening the legacy itself. And then it comes to that consistency. To speak to that example, it reminds me of the story of the tortoise and the hare. They're presenting the IUL as this amazing product that has this unparalleled growth. But how many versions of the tortoise and the hare have you seen? And then I want you to find me the one where the hare actually wins. It never happened. And it's not going to happen here either.
Yeah.
And then you said something else when you talked about the structuring and the software, and I'll leave you with this, and then you can close us out. The software is built to maximize the profitability for the insurance company by default. And
Yeah.
then you have these levers that you can move where you can maximize the profitability and the commission for the agent, which is usually a tell when you look at the illustration, when you see zeros early on.
I
It's
know.
already not comparative cash value to the whole life, but when you see zeros, it's like, who did this to you? And you should call somebody and let them know the
Yeah.
state of insurance, because one of the major reasons that a lot of IUL people learn about the participating whole life or true infinite banking and then go back to IUL, aside from the fact that they don't want to deal with the learning curve, is because if I structure an IUL for infinite banking and structure the same whole life for infinite banking, not only do you have more flexibility in the whole life policy, but you also make about a quarter in the whole life policy by doing the right thing of what you would
Yeah.
make in the IUL. And for a lot of people, they're not interested enough in doing the right thing to stomach that 50 to 75% loss in potential commission by doing the right thing.
Definitely. You
And that's troubling.
you hit the you hit the nail, right? The hammer and the nail on the head. So because like you said before, agents don't want to sell something that they feel is complicated to them because they don't want to learn something new. Because then they'll have to educate themselves and then have to educate the client when they can just sell something, make the top dollar, right? So an example, an agent selling an IUL for $500 a month, $6,000 a year, they're probably going to make somewhere between 5 to 6,000 on that deal. You, as the client, have zero access to cash or very, very minimal, even if it was a good agent, right?
Like 2000, 2500.
So when it comes to infinite banking, whichever carrier we use, which is not that many, because we use very specific carrier when it comes to mutual owned and versus stock owned, which is another segment for later. But that same $6,000 premium that you're paying in an infinite banking structure, a hybrid whole life, the agent might make 2,500 to 3,000 on that six, but they're not coming from your pocket; it's coming from the insurance company pocket
Mm-hmm.
for bringing them a client they didn't advertise for because there's no surrender penalties on the whole life structure that we have. Versus the IUL, they have to have a surrender penalty because they're giving you so much commission from the client's premium, it's going to you, agent. That's kind of the differences. So number one, the agent doesn't want to make less, they want to make more, no matter who it hurts. And number two, they don't want to learn it because it's too complicated for them. But it's not really if they really just sat down and really studied it and learned their craft and honed in on it. Because the number one thing that I find with infinite banking is because this is something that needs to be retrained and re-educated with our clients. Like I just had a meeting of a 3-year-old client today, this morning. It went very well because he was about to cancel his policy because he has more debt from his business and other hardships came up. But I strictly said, we haven't had that review in like over a year, and I'm sorry for that. But doing customer service and retention and meeting with your client is more valuable than trying to get new ones. And if we just take care of that, right? We'll just get more business over time. But it's all about re-educating people. That's really the harness and the power of what Hidden Gems and Do What Banks Do at American Capital Life are trying to do is we want to work with clients forever, not new ones every time, right? We're like a doctor. We don't want to be like car sales. We want to take care of the client. I'll bring up just two things. Well, actually, that was one of the things was the commission side. But the second thing is just giving you a story about the client when you're looking at this illustration. Now, we have a 31-year-old, I think he's 30, 31-year-old, and they were going to put in $4,200 or, 5,000, make it easy, 5,000 a year. And 30 some odd years. So you're looking at over, when it's all said and done by 60, 65, whatever it was, it came out to like 190 plus $1,000 of premiums over those years of their money. Then when they have the income coming out, it was over $100,000 per year. So now you're 66 years old. You gave almost $200,000 of premium, and now you get to take 100 plus $1,000 every year tax free for the rest of your life. So on the IUL illustrations, you have three different columns on some carriers where it's zero, like guaranteed at 0 or 2%. And then there's 4.5% on the alternative column of the index. And then they have the non-guaranteed at 6.9%. So if you're looking at these columns on illustrations, if you look at the middle column or the 4.5% indexing for the alternative scale, if you're looking at that from 66 years old to 70 years old, 71, there was zero cash value at 71 years old, which means if anyone is hearing this, at 4.5% every year for 50 plus years, right? She's been getting 4.5%. There is no more cash in that account. That policy is imploded. It's exhausted because it's too expensive because the cost of insurance is eating into it. Because even though you stop making the premium payments at 65, 66 years old, it doesn't mean the cost of insurance stops. In a universal life structure, not whole life, universal life, right? The cost of insurance continues forever, even though you stopped it. So now imagine taking 700 plus $1,000 of borrowed money, and now there's no more policy. Now you're going to get a tax bomb from the insurance company. So, well, but not even that, Wayne. I mean, people don't understand what's going to happen. I said if the client lives till 80, let's just go even further, just for common sense, because everyone here listening or watching, just common sense wise, would you give me $1.6 million tax free from your business for only collecting $200,000 of my money? Would you do that, Wayne? Would you give me 1.6 million if I only gave you 200?
No,
No.
I'm not even.
Why the heck do these carriers, oh, sorry, why the heck do these agents think that carriers are going to do that? And why do the clients think they're going to get 1.6 million tax free for only giving a company 200,000 without asking themselves the same question? Would I do that for anyone else? It's not going to happen. It's math. It boggles my mind that agents believe this stuff. And even the $1 million babies out there that are talking about children policies, like putting in $200,000 or $100,000 for 15 or 20 years is going to create $3 million tax free to your child at 65. What company is going to give you $3 million tax free for only collecting 200,000 or 300,000 of your money? But it looks good. So I'll close. I mean, you can piggyback on that before we close, but it's just, it's unrealistic and numbers don't lie. And you just got to ask yourself, would I do the same thing if
They
I
don't. They don't. But the people manipulating it do, or the people interpreting the numbers definitely do. And I mean, I think you said it. You said everything that needs to be said in regards to the policies, the way that they're structured, and it goes back to what I said before. It really just comes down to, and I know common sense isn't common, but it really comes down to common sense. And if it sounds too good to be true, then it is, because just again, common sense, Ray Kroc, Disney, J.C. Penney, whoever you want to use, and just Google when the IUL came into existence, and the timelines don't line up. It's like, and I said this in another, I used something like this similar in another piece of content that I recorded. It's like saying when Paul Revere rode into town saying the redcoats are coming in his Tesla. Doesn't make any sense, and neither does this. And I know that's egregious, but that's what that sounds like to me.
it's funny. I laugh at it. And for you and I know it's nails on a chalkboard when we see these things on social media and people are buying it. One thing to mention to everyone is, even though when we talk about infinite banking and everyone says that also is too good to be true, it's not too good to be true if we can provide you the proof and validation and transparency of showing your own policies. And I always get this statement from people when I show them my stuff and we explain it, and then they actually get it. They always ask me, one, why don't they teach this to anyone? And why doesn't everyone know about it? And the same thing, I just asked them the question back. If you knew exactly what I just told you and showed you of my own personal stuff, right? Would you ever put money into a bank if you could? They say no. Okay. And if I told you everything that you can do with this policy without taxes, penalty, liability, or risk, like a 401k or retirement account that you keep putting money into, would you ever want to give your money to Wall Street or 401k when you could do it here with full access and growth? No.
Right.
Okay. Well, then Wall Street would be shut down and you would give money to a bank. So that's why they don't want you to know. So that's why they don't want you to know that stuff. Because if you did know it, you wouldn't give them. Then we wouldn't need banks. Wouldn't need Wall Street. So that's the problem, is they don't want you to know it. But since Wayne and I do know it, we can help one person at a time and build your next generation. So that's our goal, is to help you understand it. Education first is where we come from. So
Absolutely. Absolutely. I mean, Scott, do what banks do on Instagram, Wayne runs, and then dowhatbanksdo.com, hiddengemsfinancial.com. You can DM us, comment below. If you want to hear about something else or hear our take on something else, or just reach out directly and we'll have a conversation. No sales, just education. Whatever you decide to do is fine with me. I just want you to make an informed decision and we'll go from there.
definitely pleasure as always. Hope to speak to you guys soon. Take care.
Of course.